Co-founder of the Shiller Home Price Index, and he's the author of the best-selling book, Irrational Exuberance. Professor Shiller, thank you so much for being here. And I know you've been looking at this for a long time. It's the CAPE readings that you look at, the cyclically adjusted price-earnings ratio that has you concerned about valuations even at these levels. Lay that out where we are on a historic basis.
Well, the CAPE ratio, monthly CAPE ratio, reached a peak of 44 in the year 2000, and that was followed by an important drop. It went down to 13, came back up to 27 in 2007, and it followed by another drop. And then we were recently back up to 27 again. It does seem to forecast somewhat. It's not reliable, but it's a warning signal. And we're still, the CAPE ratio right now is around 25. It's high.
Walk me through exactly what the CAPE ratio measures again. I know it's cyclically adjusted. It takes a look at earnings over how long, 10 years?
Over 10 years, yeah. That's much longer than most business cycles, so it averages out over the business cycle. The ordinary price-earnings ratio is misleading because earnings can drop precipitously in a recession, and they're volatile from year to year. So we just take a long average. It's not a new idea. You know, you find the beginnings of this in Graham and Dodd in 1934. It's been mentioned over the time, but it's never become a standard. It should be a standard. It's a standard of valuation for the whole stock market.
Based on those valuations, though, if you look at a CAPE index of 25 right now and realize that a 17 has been the historical average, that gets you to where on the Dow and the S&P? If we were to fall back to a 17.
Something like 11,000 on Dow and 1,300 on S&P 500.
That is
quite a bit lower.
That's quite a bit lower. That's a lot of pain between now and then. And you point this out, but you also caution that this is not necessarily something that the market will revert to instantaneously, and that stocks could go higher from here too.
They could go a lot higher. I just mentioned that CAPE got up to 44, even higher on a daily basis. So that was in 2000. Nobody can really forecast the market accurately, but I think this is a risky time. I think there is a risk of substantial declines, as well as increase. I'm sorry, I can't do better than that.
In terms of how you behave yourself based on this, and obviously nobody can time a market perfectly, but in terms of what you're doing yourself, have you taken money out of the stock market?
Yes, but I don't take myself as a model for everyone else. Everyone's different. People need to look at their own risk situation. But this advice that one should not react to a stock market drop like we've seen in the last 10 days or so is, I think, a little bit misleading. Maybe it's someone's goodwill effort to stabilize the market and tell people not to overreact. Well, one shouldn't overreact, but the market is high now, and people have to look carefully. You know, maybe this recent turmoil is making many people think that this is a time to look at their holdings and see whether their exposure to the market is right. Some people are surely overexposed and ought to reconsider.
Having said that, though, we do talk an awful lot about the millennials, and the millennials, for large part, and again, we're talking about a third of the population, so it's hard to not talk in broad strokes of judgment here, but many of them have been reluctant to get into the stock market all along because they grew up watching what happened in 2008 and 2009. Having said that, would you tell people of that age not to at least start thinking about stocks and start thinking about it as a way for retirement?
Yeah, well, it's interesting if you ask for that age group. There was a recent book by Barry Nailbuff and Ian Ayres that said, hey, people, this was a few years ago, but hey, people in that age group should be on margin. They should be leveraging up because people in that age group can afford to lose money. You know, they've got years of earning ahead of them. That would actually be a somewhat appealing thought to me, except for the situation we're in right now.
Right.
So maybe they ought to consider buying stock on margin. The margin credit is too high.
Is ever a good idea for most retail investors.
Well, this was a controversial book, and I'm saying I found it interesting. But older people shouldn't be leveraging themselves up. I mean, people who are living on retirement, I think this is a dangerous time.
All right. Professor Shiller, I want to thank you for being with us.